Hey there, dividend hunters. Today we're diving into something super exciting. Singapore's dividend season is heating up right now, with over 30 companies about to shower shareholders with cash. If you've been looking to boost your passive income, you'll want to stick around for this complete guide to upcoming payouts. Many investors think dividend investing is boring or only for retirees. But what if I told you that some of these stocks are offering yields up to 9.8%? That's right. In a time when bank interest rates are struggling, these dividend powerhouses could significantly boost your passive income stream. I've analyzed the entire dividend landscape for April and May 2025, and I'll break down exactly which companies are paying, when they're paying, and which ones deserve a spot in your portfolio. Hey friends, welcome back to the channel. I'm Iggy, and I've been covering topics like stocks, finance, CPF, and everything related to growing your wealth. The investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers, with over 850,000 reads and 53,000 likes. I've produced over 800 videos with more than 350,000 watch hours as of February 2025. I also focus on regional and global economic trends. Today's video will cover the upcoming dividend landscape, top dividend yields to consider, whether dividend capture strategies actually work, how to build a sustainable dividend portfolio, and a practical action plan you can implement right away. Let's get started. Let's start with a look at the dividend landscape for the next few weeks. We've got payouts coming from banking giants, REITs, industrial players, and more. But before we dive into the highest yields, let's talk about some solid performers that might not top the charts, but offer reliable income. The banking sector in Singapore has always been a cornerstone for dividend investors. UOB is leading the pack right now with an impressive $1.42 per share dividend going ex-dividend tomorrow, April 28th, 2025. That's a yield of 5.1%, which is pretty substantial in today's market. If you buy today, you'll see that cash hits your account by May 13th. Hong Leong Finance is another strong contender with a 5.5% yield. Their Store 10 dividend has an ex-date of May 5th, with payment coming on May 22. What makes these banking dividends particularly attractive? Unlike some high-yield stocks that might be facing business challenges, Singapore's banks have maintained strong balance sheets and consistent dividend histories. They're like the reliable friends who always show up when they say they will. Have you ever wondered why bank dividends tend to be more stable than other sectors? It's because their business models are diversified across lending, wealth management, and other financial services, creating multiple income streams that support those dividend payments. If you're building a dividend portfolio, having at least one banking stock provides a solid foundation. Think of it as the concrete slab your house is built on, not the most exciting part, but absolutely essential for stability. Now let's move to everyone's favorite income vehicles. REITs. Why do Singapore investors love REITs so much? Simple. They're required to distribute at least 90% of their taxable income to maintain their tax benefits, which translates to higher yields for us. Mapletree Logistics Trust is offering a juicy 7.1% yield with its Surabaya 1955 distribution going ex-dividend on April 30th. That's just 3 days from now. If you're watching this video on Sunday, you still have time to get in before the ex-date. Mapletree Pan Asia Commercial Trust follows with a 6.6% yield, going ex-dividend on May 2nd, while Suntec REIT provides a solid 5.2% yield with the same ex-date. What's your REIT allocation looking like right now? If you're underweight in this sector, these upcoming ex-dates might be a good opportunity to add some high-yield positions to your portfolio. One thing to keep in mind with REITs: they're more sensitive to interest rate changes than some other dividend stocks. When interest rates rise, their borrowing costs increase, which can put pressure on distributions. But with many analysts expecting rates to moderate in the coming year, REITs could see renewed interest from income-seeking investors. Some of the best dividend opportunities are hiding in sectors that don't get as much attention from income investors. The industrial and manufacturing space has several companies offering impressive yields in the coming weeks. Venture Corporation stands out with a substantial SUR 50 per share dividend and 6.5% yield, going ex-dividend on May 5. Yangzijiang Shipbuilding offers a competitive 5.5% yield with the same ex-date, while UMS Holdings provides a generous 7.4% yield with an ex-date of May 7. These industrial players might not be household names for every investor, but they're showing strong commitment to shareholder returns. And isn't that what dividend investing is all about? If you're looking to diversify your dividend income across different sectors, adding an industrial component can provide balance and potentially higher yields than some of the more popular dividend sectors. Now, let's talk about what everyone really wants to know. Which stocks are offering the highest yields in the upcoming dividend season? SBS Transit tops the list with an eye-catching 9.8% yield, going ex-dividend on May 2. That's less than a week away. UMS Holdings follows with a 7.4% yield. Ex-date, May 7th, and Mapletree Logistics Trust rounds out the top three with a 7.1% yield. Ex-date, April 30th. But here's where I need to add a word of caution. Unusually high yields sometimes signal potential concerns about sustainability. It's like seeing a too good to be true deal. Sometimes it actually is too good to be true. Always look beyond the yield number to understand the company's dividend history and payout ratio. Is this a one-time special dividend? Has the yield jumped because the share price has fallen? These are important questions to ask before jumping in just for the high yield. What's your approach to high-yield stocks? Do you grab them for the income, or do you prefer more moderate yields with better growth prospects? Drop your thoughts in the comments below. Dividend capture strategy, smart move or waste of time? I get this question all the time. Iggy, can I just buy before the X date, collect the dividend, and then sell? It sounds great in theory. Quick cash without long-term commitment. But does it actually work? Here's how dividend capture works. You buy shares before the ex-dividend date, hold through that date to qualify for the dividend, then sell after capturing it. Simple, right? Not so fast. There's a catch that many new investors miss. Share prices typically drop by approximately the dividend amount on the ex-dividend date. This means your capital gain/loss often offsets the dividend received. Let's look at a real example with UOB. Current price, around $28. Dividend, so on 42s. Expected price drop, about 5% on the ex-dividend date. After accounting for trading costs and potential price movements, dividend capture often becomes a break-even strategy at best. It's like trying to pick up pennies in front of a steamroller. The risk might outweigh the reward. Dividend capture might work better for investors with very low trading costs, favorable tax situations, or strong views on a stock's short-term price movement. But for most of us retail investors, a buy and hold approach to quality dividend stocks usually produces better long-term results. Have you tried dividend capture before? How did it work out for you? I'd love to hear your experiences. While it's tempting to chase the highest yields, building a sustainable dividend portfolio requires looking beyond just the upcoming payment dates. It's like building a house. You need a solid foundation, not just a fancy roof. What factors should you consider when evaluating dividend stocks? Let's break it down. First, look at the payout ratio, the percentage of earnings paid out as dividends. For most industries, you want this below 80%. UOB's payout ratio is around 50%, which gives them plenty of room to maintain or even increase dividends in the future. Second, check the dividend growth history. Has the company consistently increased its dividend over time? Venture Corporation has shown solid dividend growth over the past 5 years, which is a good sign for future increases. Third, assess the business stability. Is this a company that can weather economic downturns? Shang Xiong, for example, sells essential goods that people need, regardless of economic conditions. Fourth, examine the balance sheet. Companies with low debt-to-equity ratios have more flexibility to maintain dividends during tough times. ST Engineering has maintained a strong balance sheet, making their dividend more secure. Finally, look at free cash flow. Companies need consistent positive cash flow to sustain dividend payments. Comfort Delgro has demonstrated stable cash generation over the years. Let's apply this framework to a few upcoming dividend payers. UOB has a sustainable payout ratio around 50%, a consistent dividend history with growth over time, and a diversified banking business with strong Singapore presence. While rising interest rates might affect loan growth, UOB remains a core holding for income investors. Mapletree Logistics Trust has a typical REIT payout ratio around 90%, a well-diversified portfolio across Asia, and consistently high occupancy rates above 95%. Higher interest costs are a challenge, but it remains a solid choice for your REIT allocation. Sheng Xiang offers a reasonable payout ratio around 70%, proven business stability through economic cycles, and steady expansion of its store footprint. It's a defensive income play with built-in inflation protection. One major advantage for Singapore investors that often gets overlooked: most dividends received from Singapore-listed companies are tax-free. This tax efficiency makes dividend investing particularly attractive compared to other income sources. Imagine earning $10,000 in dividends versus $10,000 in interest income. With dividends from Singapore companies, you keep the full $10,000. With interest income, you might lose a chunk to taxes. It's like getting a bonus just for choosing dividends. But for most retail investors holding Singapore stocks for dividends, you'll enjoy tax-free income, a significant advantage over interest income or foreign dividends. This tax advantage is one more reason why building a Singapore-focused dividend portfolio makes sense for local investors. It's not just about the yield, it's about what you get to keep after taxes. If you're looking to capitalize on this dividend season, here's a practical action plan you can implement right away. First, review your portfolio allocation. Are you overweight in any sector? Now might be a good time to rebalance while capturing some upcoming dividends. Second, check settlement times. Make sure you buy at least TPA 2 days before the ex-date to qualify for the dividend. For UOB going ex-dividend tomorrow, that means today is your last chance. Third, consider dividend reinvestment plans, DRPs. Some companies offer these programs, allowing you to automatically reinvest your dividends at potentially favorable prices. Fourth, look beyond the yield. Evaluate business fundamentals and dividend sustainability using the framework we discussed earlier. Finally, set calendar alerts for important ex-dividend dates for stocks you own or are watching. Nothing's worse than missing a dividend by just one day. Depending on your time frame, here are some focused approaches. If you have just 1 week, focus on UOB, Keppel, and StarHub with X dates coming up April 28 to 29. If you have 2 weeks, consider the REITs, Mapletree Logistics, MPXT, and industrials going ex-dividend in early May. If you have a month or more, take time to build a diversified dividend portfolio across the full calendar. Which time frame are you working with? Are you ready to make some moves before these X dates pass by? Remember, dividend investing isn't a get-rich-quick scheme. It's about building a sustainable income stream that grows over time. The companies we've discussed represent some of Singapore's most established businesses, many with decades of dividend-paying history. While chasing yield can be tempting, the most successful dividend investors focus on total return, combining modest yield with dividend growth and capital appreciation. A percent yield that grows 5% annually will outperform a static 7% yield over time. It's like the tortoise and the hare. Slow and steady often wins the race. So there you have it, friends. Your complete guide to Singapore's dividend season for April and May 2025. We've covered the upcoming dividend landscape across different sectors, examined the highest yields available, debunked the dividend capture strategy, provided a framework for building a sustainable dividend portfolio, and given you a practical action plan to implement right away. Until next time, this is Iggy from the Investing Iguana, helping you grow your wealth one dividend at a time. Happy investing!